Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as usual. Guys, we have two charts, scary charts, seemingly unrelated, but quite related. And we're going to explain it all in this video. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. You know, we have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
All right, Bob. So I like this because it's kind of a big picture. And I think it's going to give people like that 30,000 foot view and really give us a good frame of reference of what's going on here and why we really need to strap in now.
Yeah, so, and before we bring the charts up, really what we're talking about is, do we kind of know where the unemployment rate's going? I think we do. We finally found a predictive model that has high correlations to 90 days into the future in terms of unemployment rate. And then we have another one that's actually showing the bond market long-term look. And it's quite scary, and I think which one we want to bring up? Let's bring the bond one up first, Phil, because I think the bond one is forcing the other chart. So we have the bond market. This is price, okay, has been failing. We basically broke the trend line, and now we're sitting on an area of resistance that's now kind of support. And so what we're looking for now, at least what I'm looking for, you when you jump in, Phil, you can agree or disagree, is that I think we're going to go up and probably try to kiss that trend line, and basically you'll see the yields fall, and then we're going to have a failure there. And I think that's going to be the out year failure, 26, 27, 28, where I think nowhere is going to be safe. And what I mean by that is that normally in a recession, initially we're going to get a good return on TLT. And then I think after that, the bond market, the prices are going to collapse, yields are going to rise. And that is what I would call there's going to be no safe haven unless you're going to be in some of these short ETF instruments that don't get blown up. And so that's that side of it. And why that's important is that companies can't get line of credit now, or if they get lines of credit, they got to get higher ROI on their products. So you're going to start seeing companies start rationalizing their businesses. It's one thing to be able to run a business when you competition on ROIC is at 0%, right? It's a far other business when your ROIC has to be 15% or 20% or even higher, is that then you start rationalizing what businesses, what products, what markets that you're in. And you're going to start seeing additional consolidation. And also you're going to see the move into greater and greater automation, because going along with this inflation environment, you're going to have companies that are going to get a lot of wage pressure. And with wage pressure, good news for employees, they get it, right? They can make more money, try to survive this thing. The bad news is automation and other technologies and outsourcing becomes more viable again. And that brings us to the second chart. And the second chart's really interesting. This is hiring intentions, okay, 4-month advance. And if you notice, it's really, really close correlation to what the unemployment rate is going to be 4 months into the future. So, and this is, I have to say, Phil's been right on this, is that we're going into probably get our negative NFP prints in July and August. And I don't think they could hide the birth death model anymore. And then I think what probably will happen, Phil, is when they have this first one, they may throw the baby out with the bathwater and revise the plugs they've been putting in the system. And we're going to have a really bad NFP print, probably in July or August, because it's easier to hide in the summertime when nobody's really paying attention. I doubt they want to do this for, the August report that comes in September or in October, because people start paying attention for the election. But it looks like we're going to go negative print. We're going to have a short-term bounce in price in treasuries, which will drive yields down. Then I think it rolls over the other way, and then we're going to be in deep weeds in 25 and 26. Throw it back to you.
Yeah, this is a great chart because this is really, I think, the last shoe to drop. And we talk about timing of the market top and things like that. And it's my belief is that they're going to front run this. I agree with you, probably like August or something like that. We'll see a top in the market, and then we're going to see those negative prints come in. But watch very closely the market around that time for topping signs, failing to make a new high, pulling down, and any attempts at higher is just making a lower high. Those are your early warning signals on a daily chart that they're topping the market, because they're not going to wait for these negative prints to come out. They're going to be, their bets are going to be set. The negative prints are going to be the catalyst to drop the market and then start going into profit on those negative bets. So the way institutions typically do it, their timing isn't so perfect, but their hit rate is extremely high. So they will start legging into the market strength even as early as maybe July or something like that. It really depends, but they'll start layering in and layering in and layering in. And then sooner or later, they may be underwater actually by a lot, millions and millions of dollars on those positions, but it's fine because the horizon on that is really out till next year. And then you also want to watch an uptick in bonds. Now, going back to this bond chart, this is a problem, because this is why having so much debt, government debt, isn't really a solution. And it's at some point the piper is going to have to be talked to, because this right here is telling you that people are leery about government debt. Now, when we go into a recession, that kind of goes out the window, and you buy yourself some time, because that is the safety trade. You're going to see this. So that's why we think, TLT, that was that dip, that line there, that was that dip under 88 that was heavily bought. And I believe that a lot of the institutions are actually positioned there already ahead of this entire recession trade. So, again, I think that, I totally agree with what Bob said. I think we do get that trend line retest. That's going to be a recession trade. You could even see TLT heading back up to like $180. Don't count that out. It's going to outperform probably everything, and equities would be outperformed the most, because I think equities are going to be the worst performing asset class over the next 12 to 18 months if we get this recession that rolls in. And I think those predictive job numbers here are telling you exactly that. So, this kind of gives us a framework, Bob, time frame of what to expect. So I'm with you. I think August, maybe they can stretch it out to September. If you look at the election year seasonality, we go up out of June, up into September, pull back down into October, and then there's like that panic run into the election. And then the election usually is hedged pretty heavily. And so you'll get a unhedging effect after right after the election, like the next day or two, and you'll see one more pop. I think that pop, my prediction would be that we've already seen the high in the market. That pop will be a lower high. Everyone's going to think like, oh, the bull's back. And in reality, that's it. That deleveraging event after the election, when all those hedges come off, is the final push up that you will see for quite a long time. And then it rolls over. And all we're going to see is lower highs and lower lows going well into 2025.
Yeah, and guys, the dates that you want to keep an eye on, look, you want May 15, you want August 15, and you want to look at November 15. And the reason why those days are important is that's usually when the analysts are really starting to look at consensus for the next quarter's earnings reports. And we came out of this quarter, I think, fairly unscathed. So they're going to probably try to push it. And that's where you're going to get that June, July bump. And then when the earnings start coming out in July, reality is going to set in again. And that's why I said August 15th is my high. It could be the 22nd, whatever Jackson Hole is. But I think that's when I think the highs in. But Phil and I were talking before this podcast. We said we better be at a new high before August 15th or the highs in for the year. And then you need to be looking at your hedges. In fact, I think you need to start mimicking what the institutions are doing and start slowly getting rid of your high beta stuff and start slowly scaling into some of your short hedges that you want to do. And hopefully over the next couple of weeks, there's some new products coming out that are very interesting to me. And once they start getting a little bit more mature, the program itself is very mature. It's the new products that are going to be centered around shorting that I think are going to be really interesting to all of us. And I think we're going to like it because they really protect us from ourselves in terms of our directional bets. These programs are a little bit more nuanced. And I'm going to just leave you with a teaser there until we get into June or July, because then I think enough of them will be out to make a difference. And I'll definitely be trading them. We'll be trading them in the room, and we'll be sharing with you guys what they are, because I think this is going to be the way to navigate this recession, okay? The tools they have today for retail on the short side are very, very limited. And I think this companies, what they're doing is really, I think, opening up the playbook here a little bit that I think is pretty exciting. So with that, Phil, thank you. And you guys have a great weekend. Check us out, tradelikeagenius.com. We've been doing extremely well. Maybe on Monday, I'll flash our results again. I mean, our hit rate has been astonishing. It's even surprising me. The worm is really working. The volatility and our system seem to go hand in hand, Phil. And so, we love this kind of market. And I think we can help you navigate this stormy sea that's coming. And with that, have a good weekend.
Have a great weekend, guys.
Trade Genius.